So welcome once again to this section. We are going to look at budgeting as we continue with this model of trying to understand how companies or internally organizations operate in order to provide value. Value not just for themselves, but for the entire stakeholder body or to all users of accounting information. All right. So like I said, we're looking at budgets. And we're looking at what we mean by functional budget. So this will take the remaining part of our term. After this, we'll go into variance analysis on budgets, and then we can look at the cash budget. Okay. So overview of budget is what we look at, the benefits, the features of budgets, what functional budgets are, and then the master budget income statement. And we'll look at an example for the service sector. We'll be building on information we've gathered from the past, so we'll be using the same product lines, the guitars, okay? We'll still be using the guitar scenario in our previous lessons, okay? So the question is, what's the budget? Budget is typically a numerical representation of action plans by organization. So we have the action plans in the organization, we just convert them into figures, into numbers, okay? So we are looking at putting the longer term strategy, the long-term perspectives of the organization within shorter controllable time limits. So it is normally not ideal. It doesn't make too much sense for you to prepare a budget exceeding 5 years. It doesn't help. You want to put them within short time frames, medium time frames, which you can manage them, okay? Budget should be ambitious, yes, forward-looking, but they must be realistic. So don't try to prepare budgets which are out of place. Now, it should be such that it can motivate the employees to achieve their targets. So don't make it so rigid, make it quite inducing so that employees can use it to work hard and to achieve their performance targets. Like I said, they must be controlled, we must manage them, we must monitor them, and try to check the budgets, the plans against the actuals. And if there are any variances, investigate them and then provide explanations as to why these variances are occurring. Sometimes the variances can be favorable, sometimes they can be unfavorable. So we need to still look out for the reasons why. And of course, budget responsibility must be given to staff so that it will cause them to know that they are also contributing towards the longer term goals and perspectives of the organization. The budgeting process, or the overview, is split into two. We have the long-term planning process and then the annual budgeting process, okay? So the long-term looks at 4 specific items where we split the entire process into targets and then investment appraisals, okay? So first we establish the objectives and then we identify strategies that will help us to meet these objectives. Try to weigh these options, the strategic options, and if they are okay, proceed with it. But if they are not okay, select alternative courses of action to be able to implement these objectives. Then the annual budgeting process continues from that angle, where we would then, after you've selected or settled on alternative courses of action, you then end up implementing these long-term budgets in the form of short and controllable time scales, in the form of annual budgets, okay, in the form of annual budgets. And then we try to consider the actual against the budgeted figures. And if there are any variances, try to point them out, monitor these results, and then point out any variances and put in place some activities to ensure that these variances have been resolved. Okay, this chart we are seeing, or this flow chart we are seeing, is typically derived from Colin Drury's Management and Cost Accounting book. All right. So benefits of good budgeting. If you have a good budget, it gives us a sense of direction. It tells the company where we are going and helps us to allocate resources across different areas of the organization. Now, budgets are not done in isolation. Don't try to be in your corner as a sales department and do it all alone. You must try to work together with the operations, with the productions, to be sure that what you are preparing works for the entire organization. So it helps us to allocate resources equitably and fairly to all the various segments of the organizations. Like I said, it helps us to look forward as organizational managers and helps the entire organization to work together in meeting the strategic goals. And if there are problems within the system, the organization, budgets will highlight these shortfalls so that we can find ways and means to resolve them. And of course, budgets can be used as standard benchmarks to help appraise performances of staff. So it is used to engage or to undertake performance appraisal situations. Okay, excellent. Now, let's look at some features of a good budgeting system. Participation, everybody must be involved. Don't sit in isolation and do it. Everybody must be involved. Communication and coordination is to foster effective communication between managers and other interacting business areas. All right, so coordination, sync, let us all speak the same language. It must be comprehensive, holistic, and include all items which need to be accounted for. Don't make it rigid. It should be flexible to allow for adjustment so that when there are any changing trends in the marketplace, we can incorporate them into our entire budgeting process. And like I said, budgets should serve as standards for which we can use to appraise performances of both units, employees, and entire organization. And then it must also allow feedback processes, which helps us to take control actions, okay, against what we have set on hand and whether we really achieve them. And what corrective measures can we put in place to ensure that these targets we set, which we couldn't achieve, can then be achieved in future time periods. There's then the key word which we use as functional budget. As the name sounds, functional. It means it must work well, okay? So it looks at, for functional budgets, it goes through some processes. Remember, you could be either a production organization or a service provision organization. If it's an audit firm, we provide services. If it is something like McDonald's, okay, we produce food. So it should cut across every aspect. Functional budget cuts across every aspect of the organization, whether service or product oriented. So for every functional budget, it must look at every activity, level of activity across the organization. And it always starts with the budgeted sales. It's a logical thing to do. If you are trying to plan a budget, whether service or production, at the end of the day, what do? We sell, or we provide our services to make money. So it must always start with the sales. What will give us sales? Production. So we produce to sell, or we provide services to sell. So the sales budget must drill down to the production or service. In production, what helps us to produce? Materials. So then we drill down to the direct material budget. When we get the direct material budget, what happens? We need direct labor to work on it. Would direct labor just work on its own? No. We need the production overheads to work on it. After the production overhead is done, you remember our marginal costing scenario. We then pick up and then get our final product and we sell. So we get other sales or other non-production overhead budget. So it starts from, so the next slide gives us the breakdown of what I'm saying. So you realize we have the sales budget and also sales budget for both service and production. Then if it is for goods and products, we get production. If it is service, it is a service still dealing with volume, okay? And then for production, the material budget, followed by the labor budget, and then the production overhead budget, and then the support overhead budget. For service division or organization, we have a direct service cost, okay? A direct service cost, which will then drill down to the labor budget, and then the service overhead budget, and then the support overhead budget. So this is a logical format for which every functional budget must follow. Let's look at two quick questions. I'll leave the first part, which we've just explained from the previous slide. The second part, I'll give you the hints so that you ask yourself, which of these statements are true, okay? Which of the following statements regarding budgets are true? Departments should prepare their own budget in isolation. The key word is isolation. Is it true? Do they have to work on their own without incorporating the entire organizational strategies or objectives? Do you work all alone and keep it, or you work in tangent with the entire organization? Budgets measure the resources used up in production, okay? Budgets measure the resources used up in the previous financial period. Is it forward-looking? Are we looking at the present and the future? Or we are looking at measuring resources in the past? Remember also there's variance analysis, which looks at actual against budget. So look at that statement. It's easy, but if you think deeply, you'll get confused, all right? The budget should be rigid. Should it be rigid or flexible? Budgets are prepared for time periods less than 1 year, or 1 year into the medium term? Okay, remember it is shorter term, yes, but is it less than 1 year? Ask yourself, all right? So go through, is any of these correct or all of them are not correct? Ask yourself, all right? Okay, so we take these examples. We're preparing budgets for the guitar, like I said, and that's what we'll be using. We have the job cost cards here, or the unit cost cards here. Expected sales prices have also been added. The same scenario we're picking from the previous lectures, okay? So we have the material labor and then the overheads, and then we have the total product cost and then the selling prices. So we're looking at Flying Z and Bellycaster, these two, okay? So FZ and then Bellycaster, BC, all right? So now let's take these steps in preparing these budgets. First, we're looking at the cost, capacity, and selling price for all of these, all right? So we'll go into this very briefly, but before then, let's jump into one or two things. One of two considerations we need to look at before setting budgets is the cost, capacity, and selling price. Simply, we need to weigh the cost to be sure whether costs will remain the same, it will be fixed over the coming period, or it will change. Also, what is the cost structure? Are they fixed, variable, semi-fixed, okay, or step fixed, or what is it, semi-variable? And look at operating gearing. You remember what operating gearing is from the previous discussions, okay? Look at inflation. Like I said, will prices go up? Should we incorporate these inflationary prices or increases in general goods, in the prices of general goods and services? Will non-production overheads rise, or they will remain the same? So simply consider the cost and ask yourself, what will it be? And what will be the effect on the final cost of the product and the selling price? Do we also have the technical competence, the know-how to be able to produce the budgets? Okay, that's the first. The other thing we should also look out for. Or do we need to consider some other aspects? Do we have the capacity, the resources, the finances to run this budget and to implement them? Okay, lack of capacity or workforce will surely become a key factor to include in terms of budgeting process. If we don't have the resource, we don't have the technical know-how, we'll be working just to hit a wall and then fall back, okay? And then once again, we need to look at the selling prices, okay? What will be the effect? Will demand go up depending on the kind of prices we are using, okay? Assuming we have stable supplier prices and the necessary resources, the capacity, the know-how to meet demand, what will be the effect on the selling prices that we set, okay? Now, let's work on these items, Bellycaster and Flying Z. So using some examples, for example, let's say we are dealing with just the first 3 months, January, February, March. So the first quarter, Flying Z will gonna produce and sell. So we are assuming production and sales are the same, okay? 20, 20, and 10, and then 10, 5, 5. So we're producing 50 units and then 20 units respectively for the quarter for Flying Z and Bellycaster. If we know the selling prices, we know, we said 450 and 350, okay? It's easy to prepare the sales budget. It's easy to prepare the sales budget. So if we know the prices, we just multiply it. So we realize that these are the figures, okay? And then this is the selling price which we had for Flying Z, okay? The selling price per unit is this. So simply this times this will give us our figure. Do the same, do the same. For Bellycaster, the selling price is 350 per unit. So we simply multiply it to the units, okay? And it will give us our 3,500. Same for this, same for this, same for this. Sum the two items up, okay? Sum the two items up and we get our total sales budget for the first quarter, okay? And so overall, the total sales budget for the quarter for the two items we are producing would end up becoming 29,500. Quite easy to work. Now, it will move into our production, but like I said, production has a number of items which goes into it. So materials, labor, and then the overheads, okay? So we don't have a production budget standing alone. It's made up of 3 different components. So first, we budget for the materials. Materials, before we get the cost of the material, we need to know the quantity, after which we prepare the cost. So material budget has 2 items, okay, 2. So first the quantity and then the price per unit. Okay. So let us assume again the same units. So we're assuming that we produce the same amount for the sales. So sales and production are the same. The same units we're finding, nothing is changing, still 50 and 20. Now, we're assuming that we have 10, and we can get it from the data set that we have. So flying Z, we need 10 kilograms per unit. And in any typical exams question, you'll be given the kilograms per unit and the cost per unit of kilogram, if that is what we are using, the units. Okay, so we're using 10 kilograms. So if this is 20 units that we need, how many kilograms do we need? So is this times this giving us 200 kilograms. Same for February and then March. We sum them up, we get 500 kilograms. Okay. Similarly, for belly caster, we are assuming 5 kilograms per unit. So we cross multiply it, or we multiply it against the units that we need, and we're getting 80. All right. Very easy. So these are the kilograms we get, and we sum them up and get this. Now, since we know the kilograms, we need to find the cost per unit, and you'll be getting the cost per unit in the question. Okay. So let's assume again the cost per unit is 5 for all of them. Okay, for all of them, each of them. It may vary, but let's assume it's the same. Okay, given that it's 5 per kilogram. So remember, we had 200 and then 80 for the first scenario. So if you add them up, we get 280. Multiply them against the cost per kilogram, and we get 1,400. Do the same for February, for March, and then we get a total of 300 in terms of the materials budget. Perfect. For labor, we are assuming still the same number of units, okay? So we are assuming and we get this on the data set, that we have 8 hours per unit for flying Z and 6 hours per unit. So the question is, how many hours do we need to produce? 8 times 20 will give us 160 hours. And for 6 times 10 for belly caster is 60 hours. Do the same for February, for March, and we get the total hours given for both items. If we know the cost per unit or per labor hour, we then use it. So let's assume, given that the cost is 10 per hour for both of them, all right? It could vary anyway, but for both of them. So if we add the two figures we had for belly caster and then flying Z, we get 220 hours. So simply we multiply it by the cost per labor hour and we get 2,200, okay? Do the same for February, for March, and at the end of the day, we get a total sum of 5,200 in terms of total labor cost, okay? Quite easy and straightforward. Now we deal with the indirect overhead. So we're gonna pick the figures from the data set that we had. Remember, there were two departments, Department 1 and then Department 2. These were the overheads we computed using our absorption costing or whichever costing period method we used, okay? So when we add these two, we get this for flying Z. So if the unit we are producing for flying Z is 20, so 116.25 times 20 gives us this amount. And the same way for belly caster, Department 1 indirect cost and Department 2 allocation of indirect cost was this, giving us 87.5. So we multiply the 87.5 by 10, which gives us 875. Sum them up and we get these figures. And at the end of the day, the total for the quarter becomes 7562.5. After we've produced the indirect or the indirect cost, we now go on for non-production overhead. So it is assumed, let us assume that we have office wages is 24,000 annually. So we divide this for the whole year, 24,000 divided by 12, we get 2,000 each per month, okay? So we divide this by 12. Now, utilities, 3,000, right? It's a 6-month period. So ranging from October, November, December, January, February, March. Okay, so still 3,000 divided by 6. Just divide by 6, we get 500, 500, 500. Office rent, 1,200 for 12 months period, January to December. So again, we divide by 12 and we get an amount of 100 each. So add all the non-production overheads, we get 2,600, 2,600, 2,600, summing up to 7,800 for just the first quarter in terms of producing these two products. Okay, so we then have the master budget, which is more or less an income statement. Okay, we can still prepare a balance sheet from this and a cash flow. So the master budget looks at consolidating these into a form of an income statement. Okay, so we are going to plug all these figures we had from the above into the master budget. And if you are taking the exploring finance, you get an in-depth understanding of this, because we take a deep dive into this particular budgeting statements. All right. So in the first scenario, we had sales. We picked them just from the sales budget. Okay, we just picked them from the sales budget: 12,500, 10,750, 6,250, and total is 29,500. The material cost, we had them from the figures. Okay, and then the labor, and then the overheads. Sum all of them up, and this is what we get. Okay, we sum all of them up. So the same accounting scenario. Okay, cost of sales out of sales, it gives us our gross profit. So nothing changes here. We are now borrowing financial accounting terminologies, and we need it. Okay, they are all part of the accounting fraternity, so nothing changes. Now, if we want to get the net profit, we plug in the non-production overheads. Okay, which is the wages, utilities, and rates, which we just looked at. Okay, from the previous slides. Okay, so we then plug them in, and what we get becomes our net profit. So the net profit is the 5,700 minus the 2,600. Okay, is the 5,700 minus the 2,600. So final figure, when you sum them up, the 13,437 minus the 7,800 should give us this figure as net profit. Okay, quite easy and straightforward. Okay, so just to recap, the master budget, it tries to break down the business profitability over the period, summing up everything in the form of an income statement. So one scenario we should know is that we may not always get a profit. Okay, sometimes we can get losses. It's still part of an income statement. Okay, if the trend continues, then the business will no longer be viable, profitable, given the level of fixed costs to be covered. If we end up making losses, okay, we're not making good profit. All right. Now, additional analysis can be undertaken. You can use the contribution scenario in our break-even analysis, which we looked at in the previous scenario. Okay, we can use contribution analysis, and we can also undertake further budgeting analysis in terms of cash flow to look at whether there was shortfalls or there were no shortfall. We'll look at that in the next slide or in the next lesson. Okay, we'll look at that also. All right, so again, let's take the same job cost card. Okay, and then let's say someone is requesting for 50 units and then 20 units, and he's asking us to prepare an income statement. Let's summarize this in quite a very easy way. So what I would want us to pick to understand or to note is these two items, the overheads, okay, take note of them. And then we have our selling prices, okay. So easy to prepare, right? So the units that we're getting multiplied by the selling prices, So this is the flying Z, right? There's a flying Z, and this is a belly caster. And we got a total sales of this. Cost of sales, less cost of sales. So remember, the total cost we had, okay, was this, including the overheads, 246. So the 246 times the units, and then 187 times the units. Let's sum them up. This is what we get. Subtract this from this, and you get gross profit, not a loss. Okay, quite straightforward and easy. Now let's look at the service sector, for example. We remember we took the bus operator scenario. Okay, now with the service sector, we are dealing with services that we provide. Okay, still the same thing happens. Remember when we did the calculation, we came up, including the selling, the margin. Okay, with the amount of 1.2. Okay, so we proceed. Okay, we proceed. Yes, so we have 1.24 as a selling price, including the margin, which we added up to the cost. Okay, so if we are working 25 days, we are working 25 days in January, 28 days in February, assuming, and 30 days in March. This is the total number of days for the quarter. Okay, the miles covered by customers is 180 miles per day. So multiplied by the number of days that we worked, and we get this total number of. So when we multiply, we get this amount, and we get this total number, which is 5580, by multiplying this against the budget. Okay, against the sales budget. That's the amount of money we expect to get. Do the same for February. do the same for March. Okay, do the same for February and do the same for March, and we get these amounts. So the total sales we are expected to make in the quarter is 18,526. All right. So we deal with the service cost. What are the service costs? How many days am I working? Still same scenario. We expect that we pay them 10. We work 10 hours a day, 10 hours per day. So find the total amount of hours we work in a day, or for the whole month. Okay. So 10 times 25 will give us 250. This is how many number of hours we work in the month of January. And if the labor cost is 10 per hour given in the question, okay, then we simply get a total of 2,500 to incur in terms of labor cost for January. Do the same for February, do the same for March, and we get 8,300. Quite easy and straightforward, right? Now the miles covered in terms of operational cost, okay, we had fuel, we had garage, we had others. Let's take them one after the other. So miles we covered was 4,500, right? 4,500. You can easily compare it from this. The number of miles covered is 4,500. It doesn't change. Okay, it doesn't change. So if we go to the other aspect, it's the same. 4,500, 50/40, and 5,400. So if the fuel cost is 0.30 per mile, we just multiply it and we get these answers. Okay. So at the end of the day, we get 4,482 as the fuel cost for operations. Now we also have service costs. It sleeps, the vehicle sleeps in the garage throughout the year. Okay, so January has 31 days. February, let's say 28. March, 31 days. So cost per night is 10 times the 31 days gives us 310 times the 28 days times the 31 days. All right, quite easy. Repairs is 4,000 per year. That's what we say we were given. So simply to get for per month, we divide this by 12 to give us the 333,333. Okay, then when we sum them up, it's just a rounded figure. Okay, you get something like 333.33. Okay, so when you add them up, you get 999.99. So round it up to the nearest whole number. So you get 1,000. Insurance per year is 3,000 for the whole 12 months. So we divide again by 12. Okay, and we get this amount of money, and we get a total of 750. Sum them up and get the indirect service cost, which gives us 893 throughout. Okay. Now the non-service cost, after that we sell. Okay, but we need a sales and admin department to help us in this area. So we divide the entire annual salary, which we pay, okay, 18,000 by 12 to give us the monthly figures. Rent, 1,800, again, January to December, divided by 12, and you get the monthly figures. Okay, you get the monthly figures. Utilities is 720 for 6 months, so divided by 6, and we get the monthly figures. Sum them up, and these are the figures you're going to get in terms of the non-service related budget cost. So total is this. Based on this, we can prepare our master sales activity. So all sales figures from the sales budget, and then we have the direct labor cost, fuel cost, indirect cost, and then the non-service related costs. Plug them in and you realize that we're making losses, losses, and losses. It doesn't appear prudent to be working in this way. Okay, so we're making up losses. All right, so that's it. So overall, we've seen what the features of good budgets are, the benefits of a good budgeting process, what a functional budget is for a manufacturing and service organization, how to prepare simple budget for an organization, both for the production and then the service sector, and how we can populate it into a master budget. And of course, these are 10 key items we can always keep in mind and to understand. All right, great. So based on this, I can say that it's quite easy and straightforward in terms of the budgeting. We'll look at the next section in terms of how to go through doing and taking a variance analysis and to plug in corrective measures in terms of the budgeting process. Perfect. See you soon. Thank you.